In an environment of heightened geopolitical tensions and persisting macroeconomic uncertainties associated with the recent Russia-Ukraine crisis and headwinds stemming from the lingering impact of COVID-19 pandemic. The committee reviewed developments in the global and domestic environments in the first quarter of 2022 and the outlook for the rest of the year. These include the likelihood of tightening external financial conditions associated with monetary policy normalization in the advanced economies, the cocktail of sanctions imposed on Russia, the global supply chain disruptions associated with the invasion of Ukraine, and increasing vulnerabilities associated with the burgeoning global private and public debt portfolio and risks to financial stability. Others include increased uncertainties across major financial markets and the increased risk of continuing rise in prices confronting central banks due to the huge monetary and fiscal stimulus injected into the global economy to subdue its downside risks to growth. 10 members of the committee attended this meeting. The global development. The committee noted with concern the recent heightening of uncertainties confronting the recovery of the global economy as the Russia-Ukraine conflict and numerous sanctions against Russia introduced a new dimension to risk to the tepid recovery of the global economy. It further took into cognizance the lingering headwinds associated with COVID-19 pandemic and global supply chain constraints, rising inflationary pressure, and more recently, the progression of interest rates hike by the US Fed and the Bank of England. Members noted that the ongoing war and the resultant sanctions against Russia will continue to have a considerable impact on the global economy, global supply chain, as both countries are major players in the global commodities market. With both countries significantly interconnected to the global financial markets, global capital flows are expected to experience some downturn exacerbated by the increasing sanctions on Russia. Consequently, the earlier projections by the International Monetary Fund for global output growth in 2022 and 2023 of 4.4 and 3.8% respectively are likely to be revised downwards due to the overarching downside risks identified on the horizon. Price developments across major advanced economies continue to trend down upwards and is expected to be accentuated in the short to medium term, reflecting the persisting supply bottlenecks, rising food and energy prices, and the ongoing war, which heightened the observed trend. In the emerging market and developing economies, inflation remained high, with some economies recording inflation rates well above the average in the advanced economies. This was mostly due to a mix of downside risks from the COVID-19 pandemic, capital flow reversals, legacy structural challenges, supply-side bottlenecks, and exchange rate market pressures. In the global financial markets, investors maintained a substantial portion of their portfolios in gold and other precious metals as the uncertainty around market securities persist alongside the pandemic and the emergence of new risks following the imposition of sanctions on Russia. It is still unclear at the moment how the progression with monetary policy normalization by some key advanced economies will impact the recovery of the global economy, given the risks associated with this crisis. Investors are, however, adopting a cautious approach in view of the considerable impact of these developments on activities in the global markets. Global financial conditions are thus expected to tighten in the short term as the investment horizon gradually becomes clearer. This is expected to impact capital flows to emerging market economies as risk-averse portfolio investors adopt a wait-and-see approach. Consequently, The risks to the overall recovery of the global economy remain heightened and call for cautious policy maneuvering to avoid a sharp downturn such as experienced in 2020. Domestic developments. According to Nigerian Bureau of Statistics, NBS, real GDP grew by 3.98% year-on-year during the fourth quarter of 2021, compared with 4.03% during the third quarter of 2021 and 0.11% in the corresponding period of 2020. On a quarter-on-quarter basis, it grew by 9.63% during the fourth quarter of 2021, compared with 11.07% during its preceding quarter. This indicates the fifth consecutive quarter of real output expansion following the exit from recession in 2020. The positive performance was driven largely by the growth in the non-oil sector to 12.36% during the third quarter of 2021 from 10.99% during the third quarter of 2021. Quarrying, transportation and storage, education, financial and insurance services, information and communication, as well as steady rebound in manufacturing and mining activities were key to the growth of the non-oil sector. The committee, however, noted that although the Manufacturing Purchasing Managers Index remained above the 50 index points benchmark in February 2022, it moderated slightly to 50.01 index points from 51.4 index points in January 2022. This sustained positive performance in the manufacturing PMI reflects the resilience of the economy in light of persisting headwinds to the recovery. The non-manufacturing PMI, however, remained below the 50 index points in February 2022 at 49.0 index points, while a slight moderation compared with 41.01 points in January 2022 as legacy headwinds such as the persisting insecurity and infrastructural constraints continue to impact production and the ease of doing business in Nigeria. The committee observed with concern the marginal increase in headline inflation year-on-year to 15.70% in February 2022 from 15.60% in January 2022, a 0.1 percentage point uptick. This increase was largely attributed to a rise in the core component to 14.01% in February 2022 from 13.87% in January 2022, while food prices moderated marginally. The rise in core inflation was mostly due to rising energy prices as a result of the current scarcity of petroleum, premium motor spirit PMS, rise in the cost of automotive gas oil AGO, and hike in electricity tariff. Committee, however, expressed cautious optimism that with sustained interventions by the bank in various sectors of the economy and broad fiscal support to tame these legacy structural constraints, price developments will moderate as output growth improves. MPC therefore urged the fiscal authorities to seek innovative ways of addressing the current critical supply side challenges confronting the economy to enable the unhindered transmission of all the recently deployed fiscal and monetary stimulus to the real economy for good. Members noted the growth rate of broad money supply M3 increased to 2.12% in February 2022 compared with 1.74% in January 2022. This was largely attributed to an increase in the growth rate of net domestic assets, the NDA, to 5.78% in February 2022 from 2.62% during the previous month. On the developments in the money market, committee observed the movement in money market rates around the asymmetric corridor, reflecting the prevailing liquidity conditions in the banking system. Accordingly, the monthly weighted average open buyback rate decreased to 5.81% and 9.3% in February 2022 from 6% and 16% in January 2022, respectively. The decrease in the OBB and interbank core rates reflected the liquidity conditions in the banking system. MPC noted the sustained improvement in the equities market in the review period. The all-share index and market capitalization both increased significantly from 42,716.44 and 22.3 trillion naira on December 31, 2021 to 47,282.67 and 25.48 trillion naira on March 18, 2022, respectively. This prevailing positive performance was attributed to gradually improving macroeconomic fundamentals which support improved outcomes and returns on investment from companies quoted on the Nigerian Stock Exchange Limited. MPC also noted the continued resilience of the banking system, evidenced by the further moderation of the ratio of non-performing loans (NPL) to 4.84% in February 2022 from 4.9% in December 2021. The committee also noted that liquidity ratio remained above its prudential limit at 43.5% in February 2022, while capital adequacy ratio moderated slightly to 14.4% in February 2022 from 14.5% in December 2021. Overall, members expressed confidence in the bank's regulatory regime and commitments to maintaining stability in the banking system, urging the management to sustain its tight regulatory surveillance on the system. On the external reserve position, committee noted the decrease in the level of gross external reserves to $39.44 billion as at March 2017, 2022, from $40.21 billion as at January 25, 2022, indicating a decrease of 1.95% over the review period. The moderate accretion to reserves reflects the duality of Nigeria's position as an oil exporter and importer of refined petroleum products. Committee reviewed the performance of the bank's various interventions to stimulate productivity in the manufacturing, industry, agriculture, energy, infrastructure, health, micro, small and medium enterprise sectors. Between January and February 2022, the bank disbursed 29.67 billion under the Anchor Borrowers Program for the procurement of inputs and cultivation of maize, rice, and wheat, three crops that hitherto were significant concerns of FX demand. These disbursements bring the total under the program to over 4.5 million smallholder farmers cultivating 21 commodities across the country, comes to a total of 975.61 billion naira. The Nigerian Commodity Exchange (NCX) has also been restructured to effectively aggregate excess output from the bank's Anchor Borrower Program finance projects with the objective of moderating food prices. The bank also released 19.1 billion to finance 5 large-scale agricultural projects under our Commercial Agricultural Credit Scheme (CACS), bringing the total disbursement under the scheme to 735.17 billion naira for 671 projects in agro-production and agro-processing projects. In addition to this, the bank disbursed the sum of 428.3 billion under the 1 trillion naira real sector support facility to 37 additional projects in the manufacturing, agriculture, and service sectors. The funds sourced from the real sector support facility, differentiated cash reserve requirement, were utilized for both greenfield and brownfield projects under the COVID-19 intervention for the manufacturing sector. Cumulative disbursements under the real sector facility currently stands at 1.75 trillion naira, disbursed to 368 projects across the country. Whereas under the 100 for 100 policy on production and productivity, the bank has disbursed a total of 29.5 billion to 31 projects, comprising 16 in manufacturing, 13 in agriculture, and 2 in healthcare. As part of its efforts to support the resilience of the healthcare sector, the bank also disbursed 8.5 billion to 6 healthcare projects under the Healthcare Sector Intervention Facility, bringing the cumulative disbursements to this sector to 116.72 billion naira for 124 projects comprising 31 pharmaceuticals, 56 hospitals, and 37 other services. An additional tranche of 14.7 million was disbursed to 5 researchers under the Healthcare Sector Research and Development Intervention Scheme. To support households and businesses affected by COVID-19 pandemic, the bank disbursed 21.66 billion to 19,605 beneficiaries, comprising 12,044 households and 7,641 small businesses under the TCF within the period. Cumulative disbursement under the TCF currently stands at 390.45 billion to 797,351 beneficiaries, comprising 660,096 households and 137,255 small businesses. The bank disbursed 11.11 billion to power sector players under the Nigerian Bulk Electricity Trading Payments Assurance Facility, PAF, bringing the cumulative disbursement under this facility to 1.28 trillion naira. The sum of 12.64 billion was also released to DISCOs under the Nigerian Electricity Market Stabilization Facility, Phase 2, NEMS 2. Cumulative disbursement under NEMS 2 thus stands at 232.93 billion naira. Both interventions were designed to improve access to capital and ease development of enabling infrastructure in the Nigerian electricity supply chain sector. Our outlook. The overall medium-term outlook for the global economy remains uncertain as the war between Russia and Ukraine persists alongside the ongoing COVID-19 pandemic. The sanctions against Russia are expected to have a considerable backlash against the global economy, as Russia is an interconnected economy both in the global commodity and financial markets. The extent of the backlash has, however, not fully crystallized, but presents a significant downside risk to the recovery of the global economy if the crisis is not resolved immediately. Additionally, COVID-19 pandemic remains a significant downside risk to global recovery as the virus continues to mutate into highly infectious strains. This is impacting a high level of uncertainty on economic agents, thus creating inhibitions towards making the required investments to set the recovery on a sustainable path. As part of the lifting of restrictions associated with COVID-19 pandemic, the strong recovery of aggregate demand has continued to pose a strong upside risk to inflation as supply bottlenecks persist. This has been further aggravated by sanctions imposed on trade with Russia and other blockages associated with supplies from Ukraine. Consequently, inflation is expected to remain considerably high in the short term, even as some advanced economies progress with interest rate liftoff. The rise in both corporate and public debt in the advanced economies and emerging market and developing economies is also a major threat to global financial stability, as the risk of sustainability is heightened in the currently tense global environment. Capital flows are thus expected to be restricted as global financial conditions tighten over the short to medium term. In the domestic economy, available data on key macroeconomic indicators suggest the likelihood of subdued output growth for the Nigerian economy for most of 2022. This is hinged on the dampening impact to growth of rising energy prices in the domestic economy, tightening external financial conditions as some advanced economies pursue interest rate liftoff, as well as the persistence of legacy security and infrastructural problems. It is however expected that monetary and fiscal stimulus will remain in place to continue to support the recovery until downside risk to growth and the upside risk to inflation dissipate substantially. Accordingly, the Nigerian economy is forecast to grow in 2022 by 3.24% CBN estimate, 4.2% federal government estimate, and 2.7% IMF estimate. The committee's consideration. The Monetary Policy Committee noted with concern the impact which the global price increase in petroleum and other products is having practically on all economies. Committee further noted that this has resulted in imported inflation on the Nigerian economy and believes that specific actions need to be taken to ensure that this trend does not continue, given the adverse consequences an aggressive rising price level could have on cost of living and purchasing power of Nigerians. Before the Russian-Ukraine war, MPC was optimistic that the moderate decline in inflation was sustainable due to the positive impact of good harvest on price levels. The MPC worries today that whereas global prices have gone up, this has been compounded by shortage of supply of petroleum products. In the short run, MPC urges NNPC to take urgent steps to ensure adequate supply of petroleum products in Nigeria so as to reduce the rate of arbitrary increase in price of these petroleum products by oil marketers. The committee noted with grave concern the unprecedented rate of oil theft recorded in recent times and its debilitating impact on government revenue and accretion to reserve. In the medium term, MPC is hopeful that the proposed takeoff of the Dangote refinery in the course of the year would help to improve the supply of petroleum products in Nigeria. MPC also note that the rising price of diesel is compounded by the problem of inadequate electricity supply in Nigeria, which has adversely impacted domestic prices. MPC advises the CBN management and the fiscal authorities to take specific and urgent action to avoid many power generating stations shut down for turnaround maintenance, resulting in the current unwarranted shutdown of our generating assets. MPC is relieved that food inflation declined marginally due to good harvest. Although some scarcity is expected as we approach the planting season, the committee is optimistic that with a high level of strategic grain reserves of the CBN, it is relieved that food prices will remain relatively moderated. MPC further advised management to redouble its development finance initiatives aimed at boosting domestic food output, which would help in moderating food inflation going forward. And by extension, headline inflation could get moderated. In its consideration as to whether to hold, tighten, or loosen, MPC remained concerned that the global situation on rising prices may continue in the near term, but may begin to moderate if deliberate and urgent actions are taken by both monetary and fiscal authorities to correct the rising inflation. On another hand, the committee was satisfied that the use of the bank's discretionary CRR policy should be deployed more aggressively to control the level of money supply in the economy. In addressing the issues whether to tighten in order to rein in the rising price level, MPC was of the view that given the fragile state of the current GDP growth and the potential external and domestic headwinds from Russia and Ukraine war, a contractionary policy stance would stifle the expected investment expansion needed to drive growth and absorb the shock in Nigeria. MPC also feels that not only will tightening reverse the steady improvement recorded in credit expansion, it is also of the view that tightening would not necessarily tame the inflation, particularly where the marginal decline is relatively not yet sustainable. In the case of whether to loosen, the committee feels that loosening will trigger further liquidity surfeit and fuel inflationary pressure as available funds outstrip the economy's absorptive capacity or domestic capacity utilization. MPC also feels that loosening will trigger FX demand pressure as the excess liquidity would exert demand pressure on the FX market and trigger a naira depreciation, which would also fuel inflation. Based on the foregoing, the committee decided to adopt a hold stance as it would indicate a precautionary and consistent policy stance with the prevailing economic conditions, particularly as further economic and financial shock are exerted from the ongoing Russian-Ukraine war. Committee's decision. While growth has continued to improve, members noted that inflation was confronted with the upward pressure due to emerging risks within a domestic and external environment. MPC, however, noted that the substantial upward push to price levels, while increasing its collaboration with the fiscal authorities to ensure that inflation is adequately reined in and growth is returned to a strong and sustainable path. The committee also encouraged the bank to continue the use of its intervention mechanisms to deploy funds to the output-stimulating and employment-generating sectors of our economy. Members were of the view that tightening the stance of policy to rein inflation could adversely impact the fragile recovery of output growth and may stifle the expected investment expansion. On the strength of the above considerations, 3 members voted to raise MPR by 25 basis points, 1 member voted to raise MPR by 50 basis points, while 6 members voted to hold all parameters constant. Those who voted to raise rates, though few, feel the need to signal further tightened stance to rein in inflation. It was decided by a majority vote to retain the MPR at 11.5%. In summary, MPC voted 1, to retain MPR at 11.5%, 2, retain the asymmetric corridor of plus 100 and minus 700 basis points around the MPR, and 3, retain CRR at 27.5%, and 4, retain the liquidity ratio at 30%. Thank you for your gracious attention.